Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. In this episode, we are talking about semiconductor stocks and ETFs. Now, chips or semiconductors, they are the building blocks, basic building blocks of all computation. So that is why they have become integral in everything from smartphones to cars, laptops, PCs, video games, and data centers. And we know that the pandemic has supercharged the demand for computing. And that is one of the reasons why the world is now facing the worst chip shortage in many years. Joining me this week is my colleague, Dave Bartosiak. He's a Zacks stock strategist, and he manages the blockchain innovator portfolio, which has some great chip stocks in its portfolio. And he also manages the surprise trader portfolio. So we'll discuss the outlook for semiconductors and also some of Dave's favorite chip stocks. In the second part of the show, I will talk about the three most popular chip ETFs that are available to investors and that are quite different from one another in their approach. Dave, welcome. Great to have you on the show.
Thanks for having me.
So we keep hearing about this great global chip shortage, and we'll talk about the shortage in a bit. I think it would be helpful to start with why chips have become so important. It seems microchips are used in everything now.
Yeah, I believe it's sort of you remember the Internet of Things and how big of a deal that became just a few years ago, where you have all these new devices that are now kind of tied into the internet and have become just part of our everyday lives. So, we're talking about not just your phones or your computers and tablets, but you have your Google Homes now, you have the Nest, you have, we can go on and on about the smart home and the automation and everything. So it's just on a daily basis, our lives have changed so much and everything is so techy. And it all interacts with each other. So I think that's a big part of it. And then you have, just innovations in other industries which didn't used to be so chip heavy. So, think about how many chips you have in cars now. That's a big deal. Even in sports, we're seeing, basketballs that have chips in them so they can tell your rotation on your jump shot. It's like everything has just become this new smart world, and chips are really what are driving that. So they're not going away anytime soon or ever.
Right. Yeah, it's a smart world for sure. So everything is using microchips. Now let's talk about the shortage for the auto industry in particular. It appears that the auto industry was worst affected by this shortage. So what was the reason for that, you think? Was it just their supply and demand projections were very incorrect, or was it China's stockpiling chips? And also talk a little bit about what other industries will be significantly affected by this chip shortage.
Yeah, so it's been a big deal. It's already been a big story in the automotive world because kind of what I alluded to before, go back to let's go back to the 60s, the mid 60s in the muscle car era. You didn't have traction control. You didn't have any driver assistance systems. You didn't even have airbags. So there were no electronics to speak of other than, just the battery and your distributor cap creating spark to the engine. To where now it's all of these driver assistance technologies that you have in these cars, and your average car is anywhere between 50 and 150 microchips inside of it right now, depending on the brand. So some of the manufacturers were able to secure these deals with the chip manufacturers and not have too much of a shortage. But then there's other ones that are struggling. So just as a little bit of a note, when the pandemic hit, it caused interruptions to the supply chain that are taking months to work out, and it's something that we don't really think about in this world of this instant gratification and our 6-second videos that we're watching and the emails that get shot back and forth. Economies take a long time to react and take a long time to heal, and it's almost like it kind of goes back. If you think about our earnings estimates, and part of the reason why I like the earnings estimates with Zacks and our Zacks ranks, the earnings estimates take so long to establish a trend or move in one direction. They don't flip back and forth like a stock's price can. So it's the same with the economy. The economy takes a really long time to sort of roll over and go in one direction. And I think that's what you're seeing here with the chips, is that it took a long time for that shock to the supply chain to really begin to hit and affect consumers. And we're going to start seeing that now over the course of the next, I think we've already seen it in some industries, but we're going to see it in many more. So going back to the cars, I have friends in the auto industry that have been told, they're managers at dealerships that have been told to expect or to not expect deliveries of new cars this summer.
Wow.
And not like, oh, you're not going to get as many. Like, no, you're going to get zero. And these are large manufacturers. I mean, we're talking about some Mercedes-Benz dealerships have been warned about this. So that is such a huge deal, and it's going to have an impact on the used car market. Of course, those values are going to go through the roof. It's also going to hurt those auto manufacturers' numbers, but it's definitely going to benefit, some of the auto dealers and such. Another industry that's been affected by it, that shock to the supply chain, is just like home appliances. So you've had sort of this perfect storm of a supply shock to go along with a huge ramp up in demand, because now we're all sitting around our houses, stuck at home, looking at that old fridge going, I can't go on spring break, but I can buy a new fridge, right? So there's been a huge demand for like home appliances, but they're also in that supply chain too, as these appliances have become, quote unquote, smarter and smarter. 10 years ago, you didn't have refrigerators that, told you when you were low on milk, or had tablets built into the door where, you can use them like we used to use magnets and notes. So as those appliances have evolved, they've required more chips, and you have a supply shock, and you have a huge increase in demand, and this is what it's leading to, is these shortages. So that's why I'm still waiting on my refrigerator with the K-Cup machine in the door that I ordered in August, and it's March.
Okay, so I wanted to talk a little bit about these fabless business models now, because it appears that is also adding to the problem, because now just about 12% of chips are manufactured in the US, and it seems that the world has become too much dependent on Taiwan Semiconductor, and to a lesser extent on Samsung Electronics too. And TSMC, or Taiwan Semi, it is the world's largest and most advanced contract chip manufacturer, and it is being used by leading US chip companies, including NVIDIA and AMD, for production of their chips. They had started outsourcing their manufacturing years back. And Intel, which was, once the leader in the US chip market, it still uses its own factories to manufacture the chips that it designs. But Intel has fallen way behind TSMC in the manufacturing technology, and that is why it continues to lose market share. Intel, in fact, announced a delay in its 7-nanometer chips technology, whereas TSMC will probably start manufacturing 3 nanometer chips soon, maybe later this year or next year. So talk to us a little bit about these rise of these fabless models, and what do you think of Intel's fall and TSMC's rise?
Yeah, touching on your point, 37% of the worldwide wafer fab capacity was in the U.S. in 1990. 37%, that's dropped to 12% in 2020. So rather than spend the money on the manufacturing processes, it was easier for these companies just to basically outsource that manufacturing to, in this case, Taiwan Semi. So Intel just asking Taiwan Semi to go ahead and do everything for them because it was cheaper. I think they were trying to cut costs, and it was a short-term solution that ultimately looks like didn't really work out that well for them. It's something that is not, I don't want to say it's gone for good, but it's not something that can be easily reversed. So we're not going to be able to bring on this new capacity to have these chips manufactured here in the U.S. overnight. It's something that's going to end up taking a very long time, a ton of investment, and it's just not there right now. So I saw some estimates that in order to create like a new fabrication facility here in the U.S., it would be an investment of anywhere from $10 to $20 billion. And even with that, because of how quickly technology moves, there are no guarantees that once that facility gets built, that it's going to be even tooled properly for the chips that are going to need to be manufactured at that time. So trying to catch up is going to be very difficult for these companies that have already gone ahead and done that move towards the fabless. So fabless is not fabulous for stocks like Intel. And I think that was part of the reason also, we talk about Taiwan Semi and their emergence, but also just Intel's just demise, really. And maybe Intel's demise has been a little bit overcooked. I know people are really negative on that company overall, because it seems like they used to be running the show. They were sort of the de facto chip you would go to when you were buying your PC. And then AMD was this sort of, upstart competitor to them, the underdog. And then all of a sudden AMD started surpassing them on that point. And then they somehow went from being number one to all of a sudden being number two, and just kind of being a punching bag. And so when you're doing that while you're not making strides in the manufacturing side, it's a recipe for it's not a recipe for success, that's for sure. And that's kind of some of the growing pains that Intel has been going through here over the course of the last several years. And again, Taiwan Semi, they have that advantage now. How long that will last? Hopefully they're making the right investments to where they can continue to be sort of ahead of the game. It's it's that specialization that they have where they've been doing it. They know what they're doing. They continue to add capacity, and they continue to sort of break these barriers to make those manufacturing processes even at a smaller and smaller scale. Maybe going down to the 2 nanometer barrier even around the corner. So I think they just kind of keep playing to their strength, and as long as there's this demand, they're going to be tough to topple in that space.
Right. So talking about the investments that they are making, I read recently, in fact, they announced that they expect their 2021 capital budget to be between $25 billion and $28 billion. And that is double the annual capex that Intel has averaged over the past 5 years, and that is according to the Wall Street Journal. Now, of course, as you mentioned, chip manufacturing is very complex. It requires billions of dollars of investments and the technology and the engineers. So this chip shortage it's not going to be a short-term problem. But last week, President Biden, he signed an executive order which includes a review of supply chains for semiconductors. And the Semiconductor Industry Association is urging the Biden administration to invest in domestic semiconductor manufacturing. So do you think that we will see greater support and greater investments from the Biden administration for domestic chip manufacturing?
Even if they do, it's not something that you can just turn on overnight. They can have, and I don't want to sound too negative here. And I always make the point that I am as apolitical as they get, right? I don't affiliate myself with any party. I just look at it as, what's really happening here. And you can have as many executive orders as you want. You're going to need to have Congress come together and provide incentives and tax breaks for these companies to build more of these manufacturing plants here in the U.S. And it's something that is going to take years to work itself out. You can't just flip a switch and all of a sudden bring on this huge supply of semiconductors. Otherwise, companies around the globe would already have been doing this for months to step in and fill the gap where this supply gap is right now. So it's not that easy. It's going to take a very long time. Now, laying that groundwork for the future is a great idea, and it's something that should be done. But you could argue it's something that should have been done years ago. In order to make sure that we're not reliant on what's going on over in China, but that sort of goes into, or not just China, but Asia in general. But that plays into what I believe is sort of a larger economic theme of this, U.S. versus the emerging Asian markets and the giants that are over there. So it's part of what the U.S. needs to do to modernize sort of across the board and protect its interests. So I'm glad that it's something that's beginning, but don't expect an overnight success.
Right. So another trend that we have seen recently is that some of these tech giants, including Apple, Amazon, they are designing their own chips. They are designing their chips in-house. Of course, they still have to rely on outside manufacturers, particularly TSMC, for producing those chips. So can you talk a little bit about this new trend, why they are designing their own chips? And also, do you think that in future, maybe 5-10 years from now, we will see Apple and Microsoft and Amazon also producing their own chips because they have a lot of cash on their balance sheets. They have the engineers. Probably they can hire their engineers. So do you think we will see these companies producing their own chips as well?
I think it's a function of them having too much money and wanting to be more vertically integrated. So they think that they can capture more profits if they just keep it in-house and do it themselves for the most part. And so that's sort of, I think, where they're starting to go with that. Time will tell if that's something that they're going to be able to maintain for the future. I think it's a little bit of a fad, and you're going to see it kind of go back away from that because that's just not their specialization. So why are you trying to open up this whole new arena? And also, if you're making chips just for yourself, then it's sort of a limited market that you're making for yourself because you can only sell it. You're not even selling it. You can only just produce it on your own. It's not like Apple's going to start making their own chip and then take out the competition for chips using that. So I think personally, I think this is going to be a shorter term trend and not something that lasts all that long.
Another thing which I wanted to discuss with you is the recent consolidation and deal making in the industry. We know that AMD is acquiring Xilinx, and NVIDIA plans to acquire the British chip designer ARM Holdings. And many tech companies, they have told the FTC that they're concerned about the NVIDIA ARM deal, which could probably hurt competition. Talk to us a little bit about the recent consolidation in the industry, and do you think NVIDIA ARM deal will go through?
So I think it's a function of these companies having a ton of money on their balance sheets, and also them being very bullish about the future. So you mentioned, NVIDIA's deal is $40 billion, which is a pretty sizable deal. But in the grand scheme of things, I don't know that it's monopolistic or anything like that. And then in addition, the other deal. There's the AMD deal, and then Analog Devices did a deal also for Maxim back in July, and that was like $21 billion. So there's been some serious consolidation, but I think it's really opportunistic because if anybody knew what the demand was for these semis, it's those folks at those companies and those insiders over there. So they know that these trends are not going to stop anytime soon, and they just want to make sure that they can be there to profit from it. And if that means you got to swallow up some competitors to do so, then that's what they're going to do.
Okay, now the most important question. Talk to us about your favorite chip stocks, and I see that you have some chip stocks in your portfolio, blockchain innovator portfolio.
I do. The chip stocks have been pretty solid performers for me in there. We talked about two of them already. I have both AMD and NVIDIA in there. I've had AMD for a while, I think since 2018, July of 2018. I've had NVIDIA there since September 2019. They've both been really solid performers. I still like them. My thesis there was really the GPU market, the graphics processing units, and how those are used for mining on the blockchain. So that's kind of why they're there. Another name I have in there is Alpha Omega Semi. It's AOSL is the ticker on that one. And also before I used to have, I think I just sold it not too long ago. Excelis is technology, which is ticker ACLS. That's a Zacks rank number 2 right now. But also what I wanted to say is, when you're on Zacks.com, you can see sort of the top industries right now. In the semiconductor equipment, wafer components industry is in the top 2% of our Zacks industry rank. The semiconductor circuit foundry industry is the top 2% of our Zacks rank. And the semiconductor equipment wafer fabrication is in the top 7% of our Zacks industry rank. So there are a ton of stocks within all those industries, which are in the good graces of our Zacks ranks. So what I like to do is find one of those industries, go ahead, just give it a click and see, who is a Zacks rank number 1 strong buy, who's a Zacks rank number 2 buy. So, for example, looking at the semi wafer fabrication, we have ASML Holdings, ticker ASML, which is Zacks rank number 2 buy. Applied Materials, AMAT is a Zacks rank number 2 buy. Lam Research, LRCX is Zacks rank number 2 buy. So, if you're looking to gain exposure to these industries, to these stocks, one way to do it is by taking a look at that industry rank and then just starting your search there. Again, these are typically higher beta names because they are within the the tech industry and the semiconductors. So beware, and I'm sure Nina has a few ideas on how you can use ETFs to gain exposure to the space too.
Very interesting picks, and thanks also for your tips for using our screener for industry rank and stock rank. Dave, thanks so much for joining us.
Thanks for having me.
So that was Dave Bartosiak. Now let's talk a little bit about semiconductor ETFs, which were among the best performing areas of 2020 because of the soaring demand for from areas like cloud computing, video gaming, and data centers. And in fact, they continue to outperform the broader market this year as well. And I think the outlook for the industry remains strong. Now, the most popular semiconductor ETF is by iShares. It is the iShares Semiconductor ETF, ticker symbol SOXX. It follows a modified market cap weighting methodology. It has 30 holdings and has a cap of 8% on individual securities. So not too much concentration in chip giants. Intel and Broadcom are its top holdings. This has over 6.2 billion in assets and has an expense ratio of 46 basis points. This ETF has gained over 85% over the past year. Now, the second most popular one is by VanEck. It is the VanEck Vector Semiconductor ETF, ticker symbol SMH. This also follows a market cap weighting methodology, and it holds 25 US listed semiconductor companies. So this has a slightly more concentrated and a little more top heavy portfolio than SOXX. This is also very popular with over 5.3 billion in assets. And this is among the cheaper ones. This has an expense ratio of 35 basis points. TSMC and NVIDIA are its top holdings. This ETF has returned about 80% over the past year. Now, the best performing ETF over the past year is the SPDR S&P Semiconductor ETF. The ticker symbol is XSD. This is an equal weighted ETF, and because of the equal weighting, its portfolio tilts a little bit away from chip giants and more towards smaller growthier companies. And this, as I mentioned, is the best performing chip ETF over the past year with a gain of over 97%. This is also one of the cheapest with an expense ratio of 35 basis points, and this has over 1 billion in assets. Now, if you want to learn more about these ETFs or the stocks that Dave mentioned, please visit Zacks.com. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcasts@Zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.